Well, good evening, ladies and gentlemen, and thank you for being with us for this special Danielcode webinar. My name is John Needham, and I'll be your host for today. And we have quite a number of new guests today, no doubt, as a result of Striker's involvement. And if you've heard some of this stuff before to our Danielcode stalwarts, bear with me because there's a whole lot of new material that you are going to find very, very explosive. Okay, so we have a whole lot to do, and let's get started. Here we are. Right, it all works, the system, isn't that great? So today, folks, Striker Securities of Chicago, who've been our preferred broker since this website went public in late 2007, asked me to do a presentation for them on the Danielcode, which I'm delighted about, and I hope all of you Striker clients, whether you are here live today or whether you're going to see this when it's posted on the Striker website, I hope you enjoy this, and I hope you start to give it some thought. It's pretty radical stuff to most of the world, because we're talking today about trading time. And there's almost no material available out there on trading time. My guess is that nobody else does it apart from a number of people who do it based on astrology, Mars retrograde and that sort of stuff. We don't do that. We don't have anything to do with those sorts of ideas. I should tell you I'm an attorney, although I haven't practiced the law for 25 years or more. Once a lawyer, always a lawyer, which means that by nature I'm cynical. And if you stay in that business long enough, you'll become cynical because you just hear so many stories that on cross-examination turn out not to be true. So you can assume that I won't tell you anything that I can't prove, and that I don't accept anything that I can't prove for myself. And that's what we do here at the Danielcode, particularly those folks who do tutorials. We take them through the whole inception of finding the Danielcode, what it is, where it comes from. In other words, making the same discoveries that I've made over many, many years. So let's move on now. And Striker Securities, the president, William Galwath, who's a delightful chap, is unable to be with us today, but he sent me his introduction, and he's asked that I read it out to you. So this is from William Galwath, president of Striker Securities. Ladies and gentlemen, it gives me great pleasure to introduce John Needham to this webinar, a friend and colleague of Striker for nearly 18 years. The entire staff here have met John in person, and quite frankly, he is one of the most colourful and cheerful professionals in our experience, and we have been around since the 1900s and met a lot of people. A little background on Striker. Founded in 1997, our brokerage company focuses entirely on service. There is no house trading, no house trading systems, and no financial ties to third-party developers. Let me repeat. Commodity trading advisors, trading educators, and trading system developers do not give money to Striker. We earn a living simply by commissions earned for our execution. John Needham is not paying me for this introductory commentary today, nor at any time in the past. I'm writing this just because I care about John Needham as a fellow Christian and his study of the book of Daniel that led to his observations discovery of the Danielcode. The rise of computer trading across global markets has given investors unprecedented access to new opportunities in trading. The proliferation of computerized trading strategy also has brought with it a demand for clear, accurate, unadulterated information about how these systems actually perform under live market conditions. The information presented by John Needham is sincere and accountable. and he's reachable to answer. In the years since we have met and known John, he answers to the same email, phone, and website. It really stands the test of time that John Needham stands out today as one of the most credible educators in our notebook and record keeping at Striker. I apologise I can't read these words in person on today's webinar. I'm juggling with my wife to raise 3 kids, and January is the worst month of all, since all 3 play competitive ice hockey and music. I have to take my twin boys, Ken and Joe, age 15. Incidentally, I can tell you that both of them have played at Carnegie Hall. Age 15 to Chicago to practice with a full orchestra, as both advance as semi-finalists in an international concerto contest Saturday. While my wife takes my daughter Meg to violin, who is preparing a concert for a World War II ceremony in a few weeks. After all this, they all have ice hockey practice before bed. It's just a busy month, and I'm not able to access a computer to remote into this website. And thus, I'm sorry, I can't. Let's go back, I apologize. Thus, I'm sorry I can't be in front of you in person, but I'm confident you all will enjoy today's talk and outlook. I have listened to several of his presentations in the past, and they are not dull. John derives his predictions and market views from his code, not from someone else's work. I wonder if too much of this consensus groupthink is going on in today's marketplace. As an example, there doesn't appear to be a single weather forecaster that predicted the historic and much-needed rains that have drenched California and the western mountains of the United States. They all were stuck in group thinking and just repeating the same old consensus. It's just an example to illustrate that so many trade educators today simply take bits and pieces of someone else's observations. You don't get that from John Needham. What you are about to hear today is from the source, the author, the explorer, John Needham. Enjoy and best of luck in 2023. Sincerely yours, William Galwas, President of Striker Security. So we're delighted to be doing this webinar for our clients and your clients, William, and we appreciate your support all the time. So let me tell you something about Striker. I've known them for 20 years, close enough. I know them more personally. John Galwas, who's the founder and now chairman of Striker. He's a legendary figure in the financial world and been a great friend to me. Some of the stories in the market that he's passed on to me have been wonderful, and some memorable lunches in Chicago still come to mind. His son William, who's now the president, he's a great man with an encyclopedic knowledge of market and exchange history, and he's overseen amazing growth in the business. Dan Neenan is the operations manager at Striker. I've known him for just as long. Talk to Dan about any questions you have. He's a first-class operator. I can say that all in the Striker family are excellent people, and you can have the utmost confidence in them, as I do. Okay, so let's get back to the world of markets, folks. Markets are rational, orderly, and sometimes predictable. The Danielcode is a set of proprietary ratios that control time and price in all markets. Incidentally, there's a box towards the bottom of your connection with GoToWebinar that says questions. If you have any questions for me, do type them in there, please, and I will make sure I deal with them during this session. So, becoming great. It's a big statement, isn't it? My mission is for all of you to become seriously great traders. To do that, you do need some background knowledge, but what you need most is a reliable and proven trading system. Trading Danielcode time cycles both as price and purely as time is the best and most efficient system that I know of. Done right, the rewards are enormous. Now, that's a big statement. I've been involved in this business for well over 30 years. And if I haven't seen it, I've heard about it. I've never heard of anything that even begins to compare with the Danielcode for profitability. And that's what it's all about. Our business is the business of making money, isn't it? And I've taught my trading systems to every possible level of people, from established hedge fund and wealth managers to complete newcomers who've never seen a trading chart. Some have become great traders, others are on their way to becoming great. and I can do the same for you. Start by visiting the Danielcode website, www.thedanielcode.com. Do take our TO3 and Plus trade signals if you're serious about becoming a great trader. The Danielcode trading tutorial, one-on-one with me, John Needham, that's your path to real success, and it's been proven over many years. So, time, the last frontier. Some of this material, folks, comes from earlier webinars, and if you want the sort of introduction to what's now progressing into our time trading, look at our last two previous webinars. They're all posted on the homepage of the website or on YouTube. Just click on them. So trading time should be the most normal thing for you, and yet there's no literature other than the Danielcode that understands, uses, and embraces trading time, which is extraordinary. If you're using daily, weekly, or monthly charts, you're already trading time. One day is simply one rotation of the Earth around its own axis. And since time is so certain, we should be able to divide the time cycles with a high degree of accuracy. And to do this, we need some basic math. So the source code from Daniel, this is a historic document, and it's a conversation about time. It's quite short, there's only 15 lines to it. But from it, we get two numbers and a direction on how time progresses. The numbers, as you can see, are 1335 and 1290. With some basic math, we get 29.6 days, which we say is a measurement of time. It's not the only measure, for example, a synodic month is 29.5 days, which is effectively the same thing. So what's a synodic month? Basically, a synodic month is the average length of a calendar month. We have calendar months of 30 days, 31 days, 28, sometimes 29. But a synodic month is the average length of a time, and that's measured by the planetary alignment. So, as an example, with the moon's rotation around the Earth, periodically you'll get the moon on the same side of the Earth as the sun, both in a direct line, and that gives you a new moon. The opposite of that, you get the moon on the opposite side of the Earth to the sun. So you've got their two gravitational pulls working against each other, and that gives you a full moon. And how synodic month is calculated is simply any known planetary alignment timed until it repeats itself exactly. And that's 29.5 days. Now, don't get hung up about the decimal points in any of this discussion. If you don't like decimal points, you're lucky. Be safe. They should disappear. It doesn't matter to us. And the reason for that is quite simply that we have 104 weekends, Saturdays and Sundays. We have another 10 or 11 public market holidays. So about 114, 115 days, or about 31% of the calendar. The bars for those days are not on our charts at all. So what I'm showing you should only be accurate to about 1 in 3 days, given that almost a third, 31 and a bit percent of days is missing. And the market, of course, has to count everything, trading days as well as holidays and weekends. So it's don't get hung up about the difference between 29.6 and 29.5. It's totally immaterial given that the market environment we are forced to work in, which doesn't account for weekends and holidays on most charts. So if we've got a time cycle of 29.6 days, we call that time. As I said, you can use 29.5 if you like, the length of a synodic month. Very scientific. It doesn't make any difference. They actually mean exactly the same thing because the decimal point disappears. So we've got time, a measure for time, and that makes times, plural, 59.32, or twice time. And then we get, as we go through those numbers, with some basic mathematics, schoolboy math in effect, we get two more numbers, 45 days or degrees, and 365.37 days, which you'll recognize as almost a calendar year. And we get a direction of how time progresses, and it's very simple. it shall be for time, times, plural, and a half. And literally, that's all there is to time. We're then faced with this issue of splitting days. We're taking 365 days and spreading it over 251 trading days after weekends and market holidays. So we should have this constant variable error of about 0.7 days. So numbers after the decimal point are immaterial. If you want to be more precise and you're a fanatic, you can take the Bitcoin cash chart, which trades on holidays and weekends, and use it for very accurate timing. I knew it would be useful for something. But markets are a reflection of human emotion. And it's amazing how they adapt to split time. So well that we say that time signals are valid for plus or minus one period, and that does the job for us. So have a look at this. This is the S&P E-mini for 2022. Starts in 2023. This is from a tutorial a couple of months ago. So it's not up to date, but it does the same thing. These time cycles identify all the major highs and all the major lows. And what I'm showing you here is just two single time cycles. Once you use them to fill in, you get literally every turn on the chart. So time and price are the same thing on different axes. This is about the hardest thing for people to accept. This is an old chart of the Canadian CAD chief, Canadian Swiss franc pair in Forex. And I put it on to show you how accurately markets track these numbers. You can see once it's running down into the blue lines, one line just sticks itself through the bottom and reverses. The next line lands almost exactly on that blue line. The next line closes exactly on the blue line. The final bar on this chart closes exactly on the blue line. And this happens all the time. And what these numbers are Danielcode time ratios. And these are members charts. I create these charts twice a week for all the markets, most of the markets that we cover. And for the ones that we don't cover, I monitor them for you and create signals for all of those markets. So we're going to talk a bit as we move on about target recognition. And what you see here is target recognition. We create these numbers from the Danielcode time cycle. And what you're seeing here is simply the time ratios. The blue ones are extensions of the range. The red ones are retracements of the range. And they are simply Danielcode time cycles. So way back in the day when I was discovering the Danielcode, the biggest shock I had is eventually I took all these ratios and simply placed them on a chart as time, as price levels, which was, I thought, a ridiculous proposition, but it turned out it's exactly true. And this idea of target recognition is very, very precise. I'm going to tell you a bit more about it in a moment. But with these members charts, we protect them for 6 weeks for clients who are paying for them. And they then go on to our chart archives page, which you can see at the Danielcode website. You don't need to be a member to see it. Go ahead and log into that. It's called Chart Archives at www.thedanielcode.com. And you'll see over 40,000 of these charts that I've created. Every chart I've created for members since the Danielcode website went public in late 2007. And I promise you, you'll be flat out trying to find a market that's turned anywhere except at the Danielcode numbers. And you should look at that tool to see for yourself the way numbers and markets are affected by the Danielcode. So market turns, we're obsessed with market turns because every trend starts and ends with a market turn. And markets, you find this hard to believe, but they are talking to you every day. Markets are literally telling you what they are doing, what time cycle they're following. And before the Danielcode, we didn't have the language to understand this. Markets have been talking to us forever, but we just simply didn't understand. Now we do, because Danielcode gives us the tools to understand what markets are saying to us. And the most common thing they're saying to us is, I know these ratios and I'm tracking it. Or else it'll say, not these ratios, try another one. And this happens every second, or at the worst, every third day. It's wonderful. It's really wonderful. As you should imagine, or you should know at least, I am totally in love with futures and forex trading. I am in awe of its precision. I am in awe of how these markets manage to organize themselves to such a perfect extent. And if that sounds silly to you, stay with us, because I'm going to prove it to you. So the most effective target, the most effective filter for your price trades is Danielcode target recognition. What is Danielcode target recognition? It's very, very specific. What we say, have a look at this page, it's just changing now. This is a Forex chart, and this is a New Zealand dollar, US dollar pair. On that chart, you can see there are some blue lines, which are extensions of the range, some red lines with a black line at the end of it, which are consolidations of the range. And have a look at this for precision. This chart was upgraded on Sunday last week. Look at Wednesday's bar. That's the big bar up. It's roared up there. What's that high? 65.30. What's the Danielcode blue line? 65.34. 4 ticks variance. We're very tough on this. We're very stringent about these target recognition rules. We say that we have to have target recognition at a high or a low or a close. If the market's going up, you'll get it at the high or a close. If the market's going down, you'll get it at the chart low or the close. And we say that that target recognition must be within 0.1% of the Danielcode number. Not 1%, 0.1%, 1/10 of 1%. So here we are, this market, 65.34 was the blue line, the high 65.30, 4 ticks recognition. That's what we call target recognition, 4 ticks variance between the market and target. And these targets go on weeks before. Some of them go on the chart months and months before, and it's quite extraordinary. Then look what happened today. The market went down. That's fine. Where did it go to? 63.61 was the 4th level of retracement on the Danielcode retracement level there, and the low was 63.65. That's the same 4 tick variance, isn't it? Amazing? I think so. Let's show you some more. This was gold today. Gold had a big rally. Go back a few days to just get the feeling for this. Go back 1, 2, 3, 4, 5 days, and you'll see the last little up bar into the high, the blue line at 1924.8. The high of the market there is 1925.3. 5 ticks variance. Then it battles away for a while. It goes down and finds support at 1897.1, which was the first retracement. That low is 1896.6. 5, 6 ticks variance. And today's high. That's a big bar up. That's a big momentum bar up. Lots of excitement. Everyone into that. Wonderful. Look where the high was. The high of today's bar in gold is 1936.9. The Danielcode number is 1937.3. 4 ticks variance, the same 4 ticks. Now, these numbers effectively are as thin as a human hair. They are so incredibly accurate, and you can go back over years and years of our charts, and you'll find this same thing happening all the time. It is truly extraordinary. And I think what you can't see here is that when I put that bar on, it was a couple of hours before the close. I'm in a totally different time zone to you people, so I have to do some of this work at 4 o'clock in the morning or 5 o'clock in the morning when the market's still running. And the gold chart that you're seeing was actually taken from about 3 o'clock today's trading. What actually happened? The high was in already, 1936.9, against the Danielcode number of 1937.3. What's not apparent from this chart is the market then finished up closing at 1923.9. Where's that other Danielcode red line? 1924.8. 1923.9. 9 ticks variance, that's all. What would we allow? Well, if you look at these numbers, they're up around the 1924 all the way up to 1941. So 0.1% of that would be 19 ticks, 1.9 points or 19 ticks. We're getting target recognition within 4, 5, 6, 7 ticks. And it does it continually, not just now and again, always. Let's move on. Here's our next one. This was an interesting trade. You can see the Russell 2000, which incidentally I think is a better equities platform at the moment than the S&P. It ran up to its the numbers. You can go 4 bars back. You can see the bar that stopped at the black line. The high of that was 1900.8. What was the black line at? 1900. 8 tick variance, that's all. The next bar struggled, poked its head through that level and pulled back. Next bar did the same thing, but it pushed up to the blue line. And the high of Tuesday's bar there is 1905.6. The blue line was at 1905.9. 3 ticks variance. That's all. Look what happens then. This market runs up, trying to rally further, and we get a huge outside bar. And the high of that bar is 1916.5. The Danielcode number up there, you can't see it. It's off the chart pretty well. What have I missed here? Something. Here we are, the one we should be on. It's over here somewhere. But that wasn't target recognition. Target recognition came from the bar immediately before the outside bar and the bar 2 bars before that. And once you have target recognition, it's valid usually for 2 days. So we had this massive outside bar, down it goes. Where did it go? Well, the low of that big first push down is 1862.8. The Danielcode number is sitting there. Can you see it? 1862.8. Perfect. 0 variance. Does that happen often? Yeah, it does. Look at what happened today. Pushed down further, found support at the 1833.9 red line. Look where it closed. 1843.3. Okay, where's the Danielcode number? 1844.9. That's a little bit large for me, but the low was valid, 1832.2 against the Danielcode number there at 1833.9. One more. Why am I showing you this? This is the stuff that it's made of. This is what markets do all the time. These charts are prepared twice a week and posted to members access on the Danielcode website. These numbers were posted on at least Saturday of the weekend. There's been 4 days, 1 day holiday, and another 3 days trading since then. But look at them. They're all just banging off the Danielcode numbers. This one is sugar. Pretty standard stuff, isn't it? The run up, the high was at 20.25. What's the Danielcode red line? 20.26. Another one, 20.27. 1 tick variance against target. That causes an outside, a key reversal bar, I should say. What about today? Down it goes. The low today, 1958. Where's the Danielcode number? 1958. 0 variance. What about the close? Well, it got better than you can see on that chart. When the time the market actually closed, the close of sugar was 1968. What's the Danielcode number sitting there looking at you? 1966. 2 ticks variance on the close. When does this happen? All the time. Every chart, all the time. final one, this is silver. I wanted you to see this massive key reversal bar in silver. Why did it happen? If you understand the Daniel code, it is, I won't say it's forcing these turns, but there can't be a turn without target recognition. That's the biggest takeaway you can get if you're talking about trading price at all. And remember, these price levels that I'm putting on here, they're Daniel code time cycles. I just created the time cycles out of the Daniel code and put them straight on a chart one day and said, wow. And we've been doing that ever since. We're using Daniel code time cycles as price. And that's because time and price are the same thing. Here we are on this, your final one of today's trading. All of these trades, incidentally, were time signal trades, or TO3 or TO3 plus trades, all of them. And some of them were very nice. So the low for this big key reversal bar, 2237.0. What's our number there? 20. Did I get that right? The right number? Try the low. 2327.0. There's your number. 2326. Pretty cool, isn't it? Where did it rally up to? Well, straight into the red line areas. Okay, let's move on. Here we are, UST bonds. One more for you to look at. This is also from today's trading. Trying to show you the same thing. When you get into the Daniel code, you'll see all of the retracements are in red, except for the final retracement, the famous Daniel code black line at 89. And that's the last level of support or resistance before the swing is broken. This market's taking great trouble not to break that resistance. It's a very important resistance. And you can see its large bar up into that 132.06 area. It took great trouble to close below the black line. And if it had closed above the black line, it would have meant something to us. It closed just below it. What happened today? This market ran up. We already had target recognition from the black line, but this market ran up, put in its high at 131.09. That little arrowhead is called a correct. So it put in its high at 131. Correct. That's the low. The high was 132. Correct 31. 132. Correct 31. See the Daniel code blue line? 132.30. One tick variance after this huge run up. Should be knocking you out, folks. It knocks me out, and I've been looking at this stuff for, well, over 28 years anyway. Okay, so let's move on to some practical ideas about trading. This is a chart that you should be familiar with. This is the S&P, the front month, S&P 500. This is the S&P E-mini contract, and this is the March 2023 contract. We have exactly the same thing on the December 2022 contract. And what I'm showing you is that this market doesn't, this contract doesn't become the front month until much, much later, well into where you see all the big bars. But look at all those little dots up there. What are they? That's trading. That's close. Occasionally there's a high and a low in there as well. Most of the time it's open and close. And I'll bet you ignore all of them. I'll bet you've never looked at them. In fact, I'll bet you never thought about them. And I'll guarantee you've never used them for creating time and price levels. Have a look at this. This is a tool that we have that we use to simply connect the black dots. And when you do that, you get some swings. Some of those swings are highs, some of the swings are lows. Now, I couldn't fit all of that on the chart in a sensible way. So I created it into our 6-bar chart. It's exactly the same data you've just seen. This is the S&P March 2023 front month. Those dots have now become lines. And if you take the Daniel code tool, we are actually creating all of the price levels that you can see, the horizontal numbers, come from those black dots. You think I'm kidding? I'm not. I promise you. This is how you do it. Look at those price levels. The first one down was the first one down is 38.39.50. That was a low and caused a rally. The next one down was 37.81.50. That gave support to the next low down. The next number down was 3688.50. That gave support, as you can see. And then finally we got down to 35.27.50, which was close enough for government business to the low. And we got the low number in price. I don't know that that's going to stay there forever. I'm very suspicious about the time cycle on it. But we got that low from the dots. You see, there is more things in heaven and earth, Horatio, etc. Wonderful stuff, isn't it? Okay, so is this just mumbo jumbo, or does it actually work? Well, anytime you know something that others don't, you have a huge advantage, and that's what makes Danielcode time trading both unique and outstanding. And remember what I said to you at the start, I'm an attorney. I haven't practiced the law for 25 years or more, but I've been brought up as an attorney. I've been trained as an attorney, which means I'm skeptical. If I can't measure it, I can't prove it. And if I can't prove it, I'm not going to tell you about it. There are lots of other ideas I have that I don't tell you about because at this stage I am unable to prove them to my own satisfaction. But there's also a lot of stuff that I can prove to my satisfaction and yours. Have a look at this. As soon as this chart changes, this is COMEX Gold. From a bit before March 2020, as much data as I could fit on the page. There's a few months more left over now, and for some of my tutorial clients who've been following that, JPR, hi to you. Hi indeed. Hope you're enjoying the show. And to some of our tutorial clients, I've shown them how to do this. All tutorial clients learn to do this stuff for themselves. Have a look at this. This is 2000, before March 2000, into after November 2022. That's a big piece of chart. It's in fact the most number of daily bars you can fit on the chart. Have a look at these time turn signals. Every single high in this whole chart has turned at a Danielcode time signal. Okay, there's a typo here, for which I apologize. This is not our 49 time cycle. We don't have a 49 time cycle. This is our 29 time cycle. Every single high has turned at an expiring 29-day time cycle. Every important low has turned at an expiring 29-day time cycle. In fact, I showed this to one of our tutorial students recently. He said, "Don't tell me anything else. I'm just going to trade this." And so, he's doing a hell of a job. It's amazing, isn't it? Every single one, every single turn, hasn't missed a turn. Every important turn happens at a 29-day time cycle. Right, so while I've got your attention, a special New Year offer. We've had a great 2022. 23 is going to be even better. I can take a few students for the Danielcode trading tutorial. And to give you an incentive, I know you like an incentive, I'm going to discount it by 20% for the first 3 clients who register with me. Now, why 3? Well, I do all of these tutorials myself, everything. And the time it takes and the preparation it takes means that it's very hard for me to do more than 4 or 5 tutorials a month. In fact, it's almost impossible. But I've got a slot in the calendar for 3 right now, and you would, if you'd like to take advantage of that, email me, please, jneedham@thedanielcode.com. And this offer is available providing you're in a position to commit before, I think I've said, 3rd of February. Which doesn't give you much time. It gives you a fortnight. That should be plenty of time. If you want to do this stuff, do it. Okay? Trading with the Danielcode methodology gives you certainty, confidence, and success in the biggest financial markets in the world. Email me today to reserve your spot. And I'm sorry, I do mean I can only take the first 3 applicants. Okay, you can read the rest of all that yourself. You should really read what Greg Palladini's got to say. He's an amazing chap, Greg, and I'll tell you something about him briefly. He's lived in California. He's a master trader and a wealth fund manager, and he joined the Danielcode in 2015. He came to his first tutorial in Los Angeles in 2016, and he came back and did another tutorial with me. I'm going to say early 2022, it might even been late 2021. And he did that to specifically learn how to trade time. Now, when Greg came back to me this time, he was a dyed-in-the-wool Forex trader. And after learning Danielcode time trading, he's now trading futures. But the point is that he has been so generous to us that on our forum, he's run a thread from early days, and he's written down his thoughts, his experiences, his understanding of everything that he's learned in his Danielcode tutorial. So if you haven't already, go to forum and click on that link and read what Greg's had to say. Amazingly generous of him. Of course, we don't very often get people who say, I'm happy for you to use my name. But it's a big thing because it's very easy to say so-and-so said this. It's very different when you put a name to it. Okay, moving on. Here we are. Now, you Danielcode folks, you haven't seen this before, so freshen up, grab top up your whiskey or whatever it is you're having at this time of the evening, and or a breath of fresh air if you're in the Southern Hemisphere. Have a look at this. From 2007. This is the S&P index now. For timing purposes, the index and the futures contract are pretty much interchangeable. Sometimes one has a little more clarity than the others, but they're completely interchangeable. Those of you who've been around a long time will have seen this because we lived through this. In fact, we traded this. And right at the low in March 2009, I was running a Danielcode tutorial in Taupo, New Zealand. And we'd seen this pattern of time developing, and we were all desperately buying the low, which came the next day. This chart gave us the closing low, which turned out to be absolutely prescient. And we had our low in price at 666 something or other. You can read about it. Go to the Danielcode website, click on the articles tab. There's about 70 or 80, maybe 90 articles there that I've published over the years. And there's one for this, and it's called 666, the number of the beast. Read it. It'll blow your head off. It blew mine off. Okay. So this is what we saw. Leading into the high of October in 2007, we observed, or I observed at least, that on our 6-day chart, which is our most common timing tool, every bar on that chart is made up of 6 trading days. I saw that the market went 59 bars, 59 days if you like, but remember each day is 6 days, 59 bars into the closing high. So the most common thing that time cycles do is they repeat. So having seen that happen, I was looking for the market to go from that high 59 cycle or 59 days equivalent into the low, which it did. And the closing low of that whole 2007-2009 crash came in March 2009. And the bar that gave you the closing low, the very next bar gave you the chart low, but the bar that gave you the closing low was exactly 59 from the high, or 118 twice 59 from where we started our count. Okay, so this idea of 59 controlling markets is not new. We've known this for a long time, and we've used it. What's more, let's see what we can do. Move on. This is the same period. Why am I showing you this? because markets tell you what they're doing, and you have to go back in time. You have to have a historical perspective to understand it. This is the dot-com high in April 2000 that then had the dot-com crash, including 9/11 tragedy, and it put in its low in August 2002. From there, it rattled along upwards until October 2007, then down it went into the March 2009 crash low. Have a look what this thing's showing us. From high to high of that pattern was 80 cycles, 80 days. Remember, when I say days, I'm talking about cycles. 80 lots of 6-day bars, or 80 days, I call it. Have a look along the bottom. From the low to the low, the swing low to the swing low, it was 70 days. You see some colored lines on there. That's our Danielcode time tool. If you've done a tutorial, you have access to that. If you're subscribed to our website Pro subscription package, you have access to that. Look at this. From the chart low, from the swing low in 2002 until the end of that crash in March 2009, 70 days. Well, 70 is very interesting to us because it's one of the Danielcode ratios. It's one we call the heathen ratio. There's nothing heathen about it. In fact, it was Sir Isaac Newton's favorite number, but it just means it comes from a different part of that writing that we use to create time. Okay, so you got all that in your head? Good. Let's keep moving. We know that 59 has been the dominant pattern into the 2009 low. So what I've done here is I've taken 59 from the 2007 high and I've repeated it. So we finish up with a bar of 118 bars, or 180 periods, and we've now moved, incidentally, to the 24-day chart. We use 6-day charts, 12-day charts, and 24-day charts for our timing system. Frank DB, who runs the wonderful Fourth Seal commentary for us every week, I think he uses 48 bars occasionally, but you're getting way out there. On the 24-day chart, which by definition is our long-term chart, it's equivalent to a monthly chart if you like, I've gone from the 2007 high, 2 periods of 59 each, and I've got to October 2018. I've done the same thing from the low. I've gone from March 2009, 2 lots of 59 cycle. I finished up with 118 at this was the COVID flash crash high of March 2020. If you remember that, it was the shortest bear market in history, but it was wonderful trading. It was something like pretty close to $50,000 for one contract. I might be exaggerating, it was a while ago. So look what's happened here. This is really interesting stuff because we've come out with our 59 cycle, which we know was valid. It has been the dominant cycle for the S&P for many years. And what it's given us is the high of the October 2018 correction and the high, the swing high, of the March 2020 correction. But wait, there's more. Those are the 2 biggest corrections since the 2009 low. They must mean something. I'm sure you've all seen them. Unfortunately, most of you didn't then make the logical step from there, but I'm going to do it for you. Look at this and think about how incredibly accurate it is. Here's the next bar. Okay? So we had our 2 lines at 118, that's twice 59. One gave us, we're still on the 24-day chart, one gave us the October 2018 high, swing high before the pullback of 4 months. The other one gave us the March 2020 high, excuse me, of the COVID flash crash. Which was like a second take. The first time there was COVID news, nobody cared. The second time, the market said, gee, this must be serious, I'm going to drop. It didn't last long. It was 24 days, the shortest bear market in history. But look what we've got from there. If we take the blue line, the vertical blue line you can see, which is the start of our Danielcode time cycle tool, from that blue line, 44 days, which is a Danielcode time cycle. In fact, it's actually the time cycle of gold. If you want to know about this stuff, do go to our articles tab on the Danielcode website. The start of this timing discussion is called Masterclass. It's about time. The next one is called Masterclass 2, Timing Gold. And if you read that, I know a lot of you gold bugs are interested in trading gold. It'll show you why 44 is the time cycle for gold. But it pops up in other places as well. And right here, 44 cycle from the October 2018 high gave us the low of this whole move we're currently experiencing. And guess what else? Look at our other number sitting there. Remember, it showed us that the time cycle between the highs was 70. You remember that? And I said to you, 70, we call it the heathen number. It's not really. It just comes from a different part of that manuscript. And Sir Isaac Newton, the father of modern science, it was his favorite number for timing. Well, what was the thing that we've missed? We put on 59s, which are twice 29, so 29's time. We've used that. 59 is times plural. We've used that several times. What's the one that's left? And half. So if you take and half of 70, which the market showed you is a known cycle, you got 35. And that gave you the January 2022 high to the bar. Cool, isn't it? Let's move on. This is moving back down in time. This is a 12-day chart. It's showing you the same thing in a different way. This is the 70 cycle, and I've just repeated it. It goes a half, 1, 1.5, 2, 2.5, 3. In other words, this 70 cycle that starts from the high in 2007, the chart high, 3.5 times that cycle gave you the low to the bar in this present market. So when you're thinking about these cycles, remember they can lie dormant, but they're chugging along, they're turning over, and then they reassert themselves. All of a sudden, bang, that's right at the low of 2009. Pretty interesting to see. Now, here's one more thing for you to puzzle about. You can see that I've put some pink highlighting over the two important swings there. The swing down from the October 2018 high and the swing up to the March 2020 high. It's pink because that's how it was on the computer, and I don't know how to change it, so don't worry about those things. You can see the area I'm talking about. And in that rally up from the 2018 low all the way up to the March 2020 high before the COVID flash crash, we had 3 inside bars, and I put a timing cycle on 2 of them. The vertical blue bars are on top of 2 individual outside bars on our 12-day cycle. Have a look what they've given us. One of them's given us the high in January 2022 at the 59 cycle. The 70 has given us the closing low just before the chart low, which came at the next bar. Perfect? Absolutely. How often does this happen? All the time. Wonderful stuff. Look at this. Outside bars are time signals. Inside bars are as well. They're actually signposts of future price levels, which means they're signposts of future time levels. And what I've done is I've moved on past the COVID low now. We know that's been an important area. And I've simply just picked out 2 outside bars. I won't say they're at random. They're 2 that were meaningful. One of them runs exactly, we're down to the 6-day chart. We're getting pretty close to this stuff. One of them runs exactly 44 cycles to the high, January the 4th, 2022. And the other one, the 70 cycle, runs exactly to the same number. So you've got 2 known Danielcode price cycle, time cycles, I should say, at a known time, which gave us the high. If we go back a couple of steps from that and we take the low before the high, we can put our time tool on that. The blue vertical line is where it starts. 44 cycles later, there's your low. 44 cycles to low. Amazing? You should be. I am. And no one is more amazed by this stuff than I am. I've been doing it for a very long time. Okay, this is called the everyday. This is what time cycles look like on an everyday chart. We are based on daily charts, and this is pretty much what it looks like. This is not real time. I've created this for you to the best of my ability. It's pretty good as far as I can see. It looks right, but you can see these time cycles are absolutely deadly. And if you don't know about time cycles, you're at a huge disadvantage because you're letting go something that has more than 50% of the information there. That's the big news. That's what you want. And to be great at this business, you've got to have every tool that you possess. And there is nothing stronger than the Danielcode time cycles. Here I've moved out to a 9-day time cycle. I know some of you say, oh, it all looks a bit busy for me. Interesting, when you move out to a 9-day time cycle, you don't. It doesn't save many trades. The numbers are not the same, but they're not incomparable either, and that's really interesting. For those of you who came in late, I'm repeating our special New Year offer of a 20% discount on the Danielcode trading tutorial if you are able to start it, commit and start it before the 3rd of February, which is a fortnight from today now. I know Americans don't use the word fortnight. My friend Greg Young, who's with us today, always tells me that his son, who understands it all, has a great laugh because I tend to use the word fortnight, meaning 14 nights or 2 weeks. That's all it means. So for those of you who missed it, there you are. Get your email off to me straight away because I can only take the first 3 people that apply. I do all these tutorials myself and the preparation for them, and there simply is no time to have more than 4 tutorials running in a month. So, folks, it's all good news. There's no inflation in trading futures and forex. Our markets pay exactly the same going down as going up, so what have we got to worry about? Interest rates only affect us as T-bond traders, and trading in T-bonds has been fabulous and continues to be fabulous, Greg, doesn't it? Yeah, equity's going both ways, much more interesting and profitable than the one-way crawl. Drama and fiscal catastrophes just add volatility. We love volatility, so happy days, folks. Learn to trade Danielcode now. And remember, the business of trading futures and forex is not to be right. The business of trading is making money. So do take advantage of our free trial if you haven't already. If you previously had a free trial, the computer will probably remember you and might not want to give you another free trial, in which case just contact Terry at support@danielcode.com. He'll fix that up for you really quickly. And here, folks, is our disclaimer. And I do ask you to read it and take it seriously. It's really easy to lose money trading if you don't know what you're doing. The business statistics are that 90% of new traders lose their money, their first bank, in the first 3 months. I reckon it's closer to 99% of the first month. Don't, I ask you, beg you, don't risk real money trading until you are absolutely sure that you know what you're doing. It's a dangerous game, and it's easy to lose your money. Once you know what you're doing, it's equally easy to make money, and lots of it. So that's grand. And I think that's all for us at the moment, folks. Thank you for being with us this evening, and I hope you found this amazing. If you haven't found this stuff amazing, I'm failing to do my job. So I'll leave it with you. It was a great pleasure being able to host you today. I am delighted that Striker were our host as well. That's the end of today's session. This video will be posted if your friends want to watch it, probably sometime tomorrow. And that's it for now. So I'm off the clock now, folks. It's Friday down under where I live in beautiful Queensland. And I've placed my orders for tonight, so that's it. Over to you. Bye-bye for now, and thank you very much for being with us today. Any questions, please email me, jneedham@thedanielcode.com. Happy New Year. Thank you, Jeff Schubert. Enjoyed it. Akshay enjoyed it. Happy New Year. Great stuff. Any update on the 30-year bond? Yes, there is, but we've run out of time now. Actually, I think it's just turning. Remember, it's government versus the market. Government usually win. Thank you for being with us for now. I'll send you if you email me, actually, I'll send you a chart of that. All the best for now, folks, and bye-bye.